Thanks for having me. So the sell-off started about a week and a half ago, but then it started to escalate down lower in the middle of this week. That was triggered by several things. So first of all, the hawkish Bank of Japan caused an implosion of the carry trade over a short-term basis. We also had bad U.S. manufacturing data out of the U.S. and some employment sub-indicators which scared markets. And then overnight, we saw a lot of volatility in some of the major earnings. And all of that helped to push equity markets, which had been quite expensive, even lower. But one thing that people aren't remembering is that usually between the period of July and October, there's seasonal rise in volatility for equity markets. So this isn't to be completely unexpected given the historical patterns around calendar effects on equity markets, especially after the fact that there was such a large rally in U.S. stocks and global stocks, the fact that earnings came in a bit kind of mixed and valuations are high, but also monetary policy remains very tight in real terms.
So there's a combination of factors, and there are seasonal elements, as you say, too, at play here. The future's pointing to an even lower start. I mean, should we be panicking? Should the market be out there sort of hitting the panic button yet?
No, I don't think so. And that's because from a technical perspective, there's a lot of support in terms of moving averages and key technical levels. At the same time, corrections are normal in a bull market. So whether this turns into a bear market or not is still to be seen. But corrections like this are absolutely normal, particularly when you have momentum, which is overdone on the upside, and you have big shifts in kind of macro market and also geopolitical expectations, which hit over the week as well. That leads to market corrections.
Okay, so broadly speaking, so there are three elements to it. There's some bit of profit taking for some markets, right? There's some correction in other markets. But for the likes of NVIDIA, right, and the AI chip market, we are well beyond correction and going into a bear market zone with the kind of sell-off that some of these stocks have witnessed, especially the chip stocks. What do you have to say about that?
So I'd say two things. First of all, you can't look at NVIDIA like a normal stock just because of its parabolic rise. So if it falls by 20%, it doesn't mean it's in a bear market. It's just a correction in what was a very large run-up. Right, so that's the first thing. The second thing is what we're actually seeing, and you mentioned rotation earlier, is that these mega cap stocks, you know, the Mag 7 or what have you, because they are falling or they led the market up so much, when they fall, they hit the market really in a bad way. And that's causing a lot more volatility than it would be normally. I think what's interesting is to see how the Nikkei, for example, is kind of paralleling some of the moves that we're seeing in US tech. So if you think about the Nikkei, it's getting hit by multiple factors, right? So the first one is the broad sell-off. It's hitting the Nikkei, and the Nikkei has been one of the darlings of asset managers. So there was a bit frothy to begin with, right? The second one is the unwinding of the carry trade. That's causing volatility for the currency, and we know that Japanese companies derive a huge amount of their earnings from abroad. So a stronger yen means lower earnings in terms of repatriated profits. But the other element as well to consider is that the Bank of Japan has become much more hawkish than what people had expected and market expectations. And what that means is that could also see tighter monetary policy, which would impact the domestic growth outlook, which then impacts domestic demand and corporate earnings and profit earnings for Japanese companies.